Ladies and gentlemen of the crypto space, we're live on a Friday, May 12th at 12:24 p.m. I totally broke my setup. Computer crashed as I was setting things up, but it is what it is. Show must go on. Let's do this. This is the best I could come up with. Desktop with the title. I don't know where the hell that damn image went, but whatever. So, obviously, the title is something we talk about a lot, my methodology to survive what is coming. And this is something that has been going on for years, me talking about how I do what I do, why I do what I do. And, it's been refined significantly. The start of this stream, we engaged in various types of activity, and that type of activity will reemerge. In late 22, Q4, August, September, is when I committed to completely removing all of the activities that I historically did, and I really settled down into a predictable methodology. And folks on the stream and folks on Discord know that income on a weekly basis is sold, and it is treated just as that. It is treated as income. And this changes the equation. This asserts methodologies talked about by Buffett. This asserts methodologies talked about by dividend investors, and this assures survivability heading into the future. Now, this is a critical time to be thinking in terms of different methodologies. There's two things that are absolutely critical. One, you must not behave like the average market actor. You must not be engaging with assets like this. This is an asset that clearly has a capacity to make an absolute few enormously wealthy, but the majority enormously poor. Now, you're not going to hear this kind of talk in social media commentary. You're going to hear hype, hyperbole, and all the bullshit that you're accustomed to hearing during the past month and a half as this has been occurring. But we're accustomed to this type of activity in years past. We've seen the ICO craze. We see that assets, systems that are absent any use are just that, worthless. PvP, predatorial behavior. They do nothing. There's no reason to own something, and it's sold. Look at this. This is a worthless asset. Community. Memes are cool. Memes are meaningful. And the value of them should not be expressed in token form. The value of them is appropriately expressed in NFT form. Utility is critical to process. There's no utility here. And utility is not in the context of what most people define utility as. Utility needs to be in the context of traditional financial products and services. This is the ultimate asset to take your capital unless you are a predator. If you could come in here with 20 mil, you can move it up and draw in additional capital. That's the entire equation for any asset that has no value, that does not pay you to own it. If it's a market cap of $50 million and you take a $5 million position and that position drives the technical chart up enough, it's going to have a psychological effect on the rest of the market, drawing in additional capital. That additional capital, when it drives the price of the asset up, the person that came in with $5 million is going to sell for a 100% return and make $5 million in a week. Because that's all they give a shit about. No one moving in with a million, 2, 3, 4, 5 gives a shit about 10,000% returns. It's not even remotely practical from a capital flow standpoint. It's not possible. And you're way past the ultra low entry points. It's just a non-starter. This is gone from an opportunity perspective. This is no way to engage with a market where you're actually going to survive. Bottom line is the vast majority of people lose everything. Now the question you have to ask yourself is, are you going to be that person that loses everything, or do you actually do something different and actually think in terms of a methodology that mathematically guarantees survivability? Survivability is a matter of doing things different. Doing things ultimately the way I've determined that I'm going to survive. I intend to survive the crypto markets, engage in the crypto markets, and use the crypto markets to fulfill what I want to be as a business owner. But I think this is the ultimate business. Look at this. Look at the conversations that are going on compared to what I just said, compared to the stories that we talk about and the analogies that we discuss and the observations that we made with regard to these crypto utilities as traditional financial products and services. We've taken the bullshit out of a market that is ripe with degeneracy, ripe with people that have a fine left curve. The market is predominantly left curve, where it's engage, buy. What are you buying? I have no idea what the hell I'm buying. I do. I have the stories, the context, the perspective, the strategy. You can't just buy shit. There's nothing to buy right now. Look at these markets. Look at this shit. Look at this drain of liquidity. How are you going to buy into a drain of liquidity like this? And this is just domestic liquidity. Let's go over to NASDAQ, which looks like it's about to put in a top, being double rejected by the 100 SMA on the weekly. Last time it hit was almost a year ago, August of 22. This has catastrophe written all over it. This has you're not going to survive shit written all over it. This has you shouldn't be buying anything right now written all over it, especially assets that are player versus player predatorial. This has please stop buying even the good assets written all over it. This has, well, let's go over here. I want this on the right. Now, it's misleading because you really need to look at it from 2020 perspective because of the amount of supply increase. This has some shit is going to go down written all over it. Why? And it's not the number, it's not the height, it's not the amount up, it's delta. All of traditional finance operates on consistency and predictability and directionality and rate of change. Not change, but rate of change. Now this, one, directionality has reversed to the downside, obviously. Two, the rate of change. Clearly it's not still heading up. The rate of change has reversed. It's downward. This has everyone in this fucking country is going to start selling shit as they have access to less and less money. The story of the dollar is not the story that most people think. You got to buy inflation-resistant assets. What is inflation? We've talked about what the hell is the difference between currency inflation, which we're looking at on the screen, and consumer price inflation. And if you don't understand the difference there, one, understand that there is a difference. And two, understand that you're not going to be able to have an asset that hedges consumer price inflation. You're not going to have something one-to-one correlated with that phenomena. So you absolutely must understand currency inflation and not just think there's a simple solution to consumer price inflation. What's the point of this last argument? The point of this last argument is that if you're in these markets, you need to define a different story. Stop listening to the social media and start putting things into a bigger picture. Listen to myself and I'll point you towards the macroeconomist. Stan Druckenmiller, Luke Groman. You want to understand the milkshake concept by Brent Johnson, but that requires a fair amount of context to have it actionable and meaningful. Time horizon is critical. Now in the short-term time horizon, the liquidity is draining from the goddamn system. You can even go to the crypto markets and see that. You're not going to survive unless you stop pulling the trigger on buys. It's a negative sum game, minus 0.63% on the week. playing around on Arbitrum, minus 3% on a week. What is that? Almost over $200 million. I think it was 2.15, maybe $2.2 billion. So there's been 200 or so million dollars that have been removed from the Arbitrum ecosystem as folks have engaged in degeneracy over the last couple of months at this point. And who's withdrawing this money? Why are they withdrawing this money? They're withdrawing this money because the large actors have capitalized on the small fish, the little rabbits, to the tune of hundreds of millions of dollars. So be different, engage differently. There's nothing to do on these chains. There's nothing systemically changing the system on these chains. Years away. Years. Mainnet is the only thing close to being something significant to the global financial system. And mainnet is basically zero, a size zero market. All the other chains are basically worthless. Now you can have fun maybe playing around, learning, educating yourself, but there's no investment opportunities on any of these chains. Now I'm getting to the point where I could say that so assertively because I guarantee you if you've been playing around on these chains, you've lost money. Most recently, your total portfolio's down. Maybe you're thinking in terms of the methodologies I talk about, dividend investing and revenue, and you've tried, but it's not working out well. Now, I know if I did that shit on mainnet, I'm not going to be making money in this market. So that gets us to where I am with my methodology, my method of engagement with this kind of market, because I will continue to engage with this market, but I have expectations, and those expectations have time horizons. What do I expect in the short, mid, and long term? Short term, you're going to see your portfolio disintegrate. You're going to see whatever value you've been able to acquire over the last couple of years melt like butter in the hot goddamn sun. And if you do things the same, you're going to see it melt faster. If you do it slightly differently, you can protect capital. So the methodology at this point reduces to a very simple equation. You want to buy things that pay you. That's the same methodology we've always been talking about. But there's nothing to buy right now because everything's going to depreciate. You're going to have cheaper prices, which means how long do you wait? You're going to have to wait a long time. You got to wait for at least information. This debt ceiling is going to be very interesting, and that's coming up in weeks. Weeks! So be studying. What are you going to buy? And frankly, the list of assets to buy is relatively small. It's the same list of assets we've talked about. At least that's the way I see it. I haven't seen anything significantly new that changes the entire equation, at least for the last year. And you're not going to see necessarily something new catch on until there's a significant increase in liquidity. But you realize if there's a significant increase in liquidity, what that means from a global financial perspective. A significant increase in liquidity is a perversion, and that's what everyone complains about. And that's why they say we need inflation-resistant assets. When they print the money printer, go burr. You know, we have partial conversation of what we think they should do from a federal policy perspective versus what they're going to do. And man, there's plenty of arguments why they should keep reducing currency and keep the Band-Aids on. Keep reducing currency supply and keep the Band-Aids on. So why is that not a path? Buying assets in this space is not going to allow you to navigate that path where M2 continues to decrease and the TGA gets refilled. They finally sell, raise a debt ceiling. They finally sell the bonds, and the TGA is refilled good part by U.S. retail, drains more liquidity. M2 comes down even more, and they use that capital to finance, all obligations, and to finance keeping the Band-Aids on while the Fed is able to keep rates at this level, as well as continue draining the domestic liquidity situation, the Federal Reserve balance sheet, as well as continuing to watch M2 contract. Why would they increase systemic liquidity? They're going to do everything they can to keep constraining and restricting and reducing liquidity. because they're going to do everything they can to keep the status quo. So the status quo requires what I just defined as a path. It's a viable path. It's a valid path. So that means there's absolute uncertainty heading into the next months. And you'll see it. You'll see when there's a change in directionality, and that change isn't right now. You don't do anything until you have confluence, suggesting, confirmation of something you're observing, a behavioral change, a policy change. There's no opportunities right now. So at the end of the week, you've accumulated assets over the last years, and claim your cash. That's income. It's going to go down. You're going to be making less cash. Your portfolio value is going to go down, but the portfolio value is irrelevant. Measure your portfolio in terms of weekly cash flow. Cash flow cost averaging is still a very interesting terminology that's come out of the last couple of years. Stop buying assets and focus on work, focus on family, focus on understanding these macroeconomic forces. Wait for more banks to collapse, more Fed policy discussion, issuance. Follow the big macro folks on Twitter. Just observe. Observe conditions. Conditions dictate path, and conditions are fucked. Conditions, find a way for conditions to bring you comfort. What does that mean? Basically, understanding of conditions. You should understand what it means. These terminologies, these discussions we talk about, you need to understand them. That's what you should be doing, not buying things. You want to buy something, you buy food at the grocery store with the cash that you received by pressing the claim button at the end of the week from assets that you're lucky to have over the last couple of years. And you're going to have to sit through with your stomach dealing with what it feels like to watch the paper value of them depreciate. Learn the emotions. Learn how to digest the emotions, how to live with the emotions. That is how you're going to survive. The number one thing I could tell anyone who has ever listened to me is this is the goddamn market to engage with. It's not the stock market. It's not the housing market. Maybe if you got the balls to start a business, but frankly, even a traditional business like a pizza shop reduces to an ROI. You deployed $1 million and you're making $200,000 a year. That's actually a heck of a business. That's 20%. But it turns out in the crypto markets, one, you could get more than 20% until things dilute in the coming years. And two, you have absolutely no overhead. You have no work to do. No labor requirements, no real estate, no supplies to purchase, no loans, short-term loans, no employees, no nothing. This is the ultimate business. It's the most incredible market I've ever seen. So look at that. That's the most interesting thing that comes to my mind when I tell you these stories, because obviously I'm screaming doom and gloom. I'm screaming the system is fucked. I'm screaming the contraction is going to be ferocious, but I'm also screaming this is where I'm at. So how do you survive here? That's what matters, and that's the equation that the general public doesn't digest when they're dealing with all the stupid meme stuff. And you're 18 years old and you're trying to be like, oh, how do I make $1 million out of $50 deposited in Pepe? It doesn't work like that. That's not the path. That's not longevity. That's not going to get you to where you want to be. So, I've seen that over the last years. 6, 7 years, 8 years at this point. And I engaged with it myself, but we've learned, we've evolved, we've grown. And that's why I tell you these stories, to learn, evolve, and grow. Be different, be an adult, and treat the crypto markets like they're an actual market and not some stupid video game. Oh, don't get me wrong, I like my video games too. Dan's in the house. Critical Mass, a pleasure. Juan, good Friday. Thank you very much for your content. It's very helpful and deep. I would ask you about your opinion of Wombat's ecosystem, irrelevant, off the radar, microscopic, measure markets in terms of liquidity. Dollars. This game is scored in dollars. And we're looking right now at dollars. So go to defilama.com/stablecoins, and you yourself will be able to assess any market in the crypto space. Markets are measured in terms of the amount of dollars that they have, because your purpose for engaging with markets is to acquire those dollars. That's the equation. So which market has the most dollars? Ethereum mainnet. Everything else is microscopic. Asmith, good morning. Henry, John, ding ding. Lord of the Pine Cones, glad to catch you live, a pleasure. Right now I moved everything to USDT. Is there any benefit to splitting portfolio between a few different stablecoins in case of DPEGs? Don't worry about DPEGs. Worry about, do you have enough cash in a bank account? Do you have enough paper cash as well? You need to be diversified. Probably want to throw in a little bit of precious metals, so diversification is meaningful. What do I mean by diversification? We've talked about over the years 1% to 10% changes everything, but it's important to have 0.1% allocations. It's important to have just stuff. Gold coins, American Eagles are lovely. Silver Eagles, lovely. I don't know about the other metals, platinum, palladium, stuff like that. They're interesting, but you could take the extent of diversification that you want, but at least have some stuff. It's interesting. It's nice to have exposure to things, because you don't know how things are going to play out. You don't know. It could be a full-on assault of crypto markets. Some country buys all the supply of Ethereum and it goes to absolute shit. Or some country confiscates all the hardware, nationalizes the hardware, and just takes control over Bitcoin. Come on, these are paths, these are considerations, this is rational. And this is the perspective that Chris Black often has, but he gets so much criticism about real concerns. Any country could attack Bitcoin. It's not in their best interest for a variety of reasons. It is in their best interest for a variety of reasons. The first rule is don't trust anything or anyone, and that's how you survive. I keep my stables in USDC. I have some DAI. You could convert relatively well. There's not much of friction in converting from one stablecoin denomination to another. Be prepared to pivot, head on a swivel, and have your risk management plans in place. If there's a problem with stablecoins, it's a big problem. There's almost $70 billion in Ethereum mainnet. That's not trivial. That's a lot of capital that's going to cause a lot of pain for people, and this is where politics comes in. And as much as they might not want the system to head in a particular direction, they do care about the population's pain. People get pissed, people get violent, people protest, people elect politicians or choose not to elect them based on their opinion of current events. So yes, there's a benefit to diversifying in stablecoin denomination. In the end, you're going to define your behavior. You're going to define your choices, and you will look back, and the path that you head down is going to be a result of the choices you made. Everyone's going to have a different path, and those are going to be the stories that you tell in the future. At the dinner table. Lucian, good night. Dan, mainnet isn't doable for all the given gas fees. Sure, GMX and similar protocols still offer people good experiences with the max degen effect, like meme coins on Arbitrum. Yes. Let's look at GMX. I mean, just look at the liquidity, though, man. Come on, this is not a good time to be buying anything. And furthermore, how does GMX fit into global financials? You're talking about trading, which is speculation on price directionality. Is that systemically significant? Is that significant? That's why I focus so much on Forex and money markets, because that's real. Man, this is a shit technical position. Breach the lower low. Your destination, anything lower than, you know, anything lower than here, 55, you're heading towards the 30s. I mean, where's the liquidity going to come from? Where's the buying going to come from? Think about this. If you're going to buy something, you want the price to go up. Arbitrum has lost 3% of its capital in the last week. So what does this mean? From my perspective, it means numbers are going to come down. It's cheaper. In 3 to 5 years, is there going to be more liquidity on Arbitrum? Probably. Is there going to be more activity in trading, more capital, more income to be earned? Probably. So if mainnet's too expensive, where's GMX going to go from a price standpoint? Because yield income is proportional to volume on the network, but as the price goes up, the relative rate of return goes down. So rate of return is inversely proportional to price point, spot price. It's just not a protocol that fits into my narrative anymore. I don't want to own exchanges. I don't want that kind of income. So in that regard, I invalidate it as a consideration. I mean, it's pretty wild. Look, that's right now. Arbitrum is in the process of potentially invalidating all price action since February 23. All of this gets invalidated if it breaches below that green line, which is its current price. You see that, right? You see how this works. It means it broke out above this top in October of 22 and this top in January of 22, and it failed to turn that historic resistance into support. This has got very much bearishness written all over it. So in any case, we started the entire stream saying there's nothing to buy. There's nothing to buy. This is education time and waiting for discounts, waiting for capitulation, waiting for some sort of financial crisis that creates forced selling, which is your opportunity to the downside. Listen, you see GMX at 13. All right, fine. Now it's pretty cheap. You look, and if you don't get those numbers, you're invalidating it as an opportunity. In this kind of reduced M2 supply domestic liquidity situation, either you're going to get a ridiculous deal or it's not a deal. That's what Buffett talks about. It's ferocious. And that also reduces the potential opportunities. That simplifies the equation. You're dealing with countless assets in these markets. How do you reduce the amount of assets you're looking at to 6, 12 of the most significant? And then you have 6 or 12 charts to look at. Then you have 6 or 12 liquidity situations to consider from a network perspective. How much capital is available? It hasn't finally reached a price where the average market actor is like, all right, fine, it's finally got into a discount. So, where would I be interested in Arbitrum? 13. Until then, I'm not too interested. And sure, you might be restricted from a transaction fee perspective. Gwei is still at 83. Still expensive on mainnet. Bear in mind, if you're engaging in very few transactions and you have a $50 or $100 transaction, and you've literally calculated that it's going to be one transaction, it's May of 23, and you're going to do 2 transactions for 23. I want to take a position in this asset, one asset that I've chosen. And I'm like, all right, if I have enough capital and the timing's right and the price is cheap enough, I'll take another position. Imagine that equation. Let's say you got $10,000 that you've saved up and you're like, all right, I need to start doing something different. Crypto markets are different. I'm going to take 2 positions in 2023. How's that for a very contrarian type of mentality for engaging with the crypto markets? Everyone's like, I want cheap transaction fees so I could buy, sell, trade, in and out, and do all of this activity. Instead, I want to own 2 things in all of 2023. And consider that. Consider that if you're just listening to me for the first time, or you're just getting into crypto markets, try it. And I think you're going to have better results taking one position, two positions in all of 2023, just a buy. And that's it. No trading. You've taken your time. You have not just conviction, but you've made an assessment that there's something meaningful, systemically significant about a particular protocol. And guess what? If you're looking at two assets and one of them doesn't reach a price point that you are calculating is going to effectively be an adequate position size, you can't take it. And now you have one position that you're potentially considering for all of 2023. If you don't have enough size of a position and you calculate what it could do in the future, it's not going to be a meaningful position. Trust me, you need decent position size. And that's just invalidates countless opportunities. Look, if I consider Bitcoin, and Bitcoin can produce a 2 to 4x by 2027 or whatever, peak of next cycle. I don't want a 4x and have to think from a capital gains perspective the amount of work and effort required to time and sell for the dollar denominated gains that I want to capture. It's not a tool that is useful for me. It will not achieve what I'm looking for. I need weekly returns. I need cash flow to pay my bills at the end of the week, at the end of the month, take care of my family. Bitcoin is not a vehicle to do anything that I need to actually live my life. Now, if you put in the other equation, where it's like, what if in 10 years and the whole stupid narrative of it being a global reserve currency, all right, so have 0.25, 0.3, a half a Bitcoin, and that is 1% of your portfolio, 2% position size. But with that 2% of your portfolio position size, don't expect that to absolutely change the financial equation of your life. It's not going to. And if you over allocate to that position and you have 100% of that 10,000 in Bitcoin and it produces a 4x into the remainder of the decade, you turn $10,000 into $40,000. You have to time the market. You're putting in all this work and effort, and you made 40 grand. And the price of gas is $12 a gallon, and a gallon of milk is like $15, $20, and the rent on your house is $5,000 a month. So all of a sudden, that $40,000 position that you have in Bitcoin, it doesn't really do shit. So Bitcoin is so not the solution for so many problems we have financially. But on the other hand, that 2% of the portfolio, can be meaningful. So that's why, back to what I said earlier about hedges and diversifying. So you have it. I have a little Bitcoin. I have some Bitcoin. I expect nothing interesting. I have it because it's contrary to my thesis of what I want to do with my portfolio. I have like 0.3 Bitcoin. I have 10 grand worth of Bitcoin or whatever the hell it's worth right about now. You don't need, if the whole system, if the whole world changes, all that matters is that you have something. Like if gold gets redenominated to $40,000, all right, fine. You have a couple of ounces of gold. You did pretty good. That's a massive denomination, and now gold has all this value relative to various fiat currencies. So that's significant, and you hedged accordingly. Small positions can be very powerful. Small positions are great to hedge against your primary position. Small positions should often be contrary to the way you think. Look, I just spent the last 10 minutes describing why I'm not too interested in Bitcoin from an opportunity perspective, but yet I have some where I could do things with that capital. And I'm like, all right, throw away the key, just in case. Just in case my theories, my narratives, my stories, my methodologies aren't necessarily what I think they are. You have exposure. So you have a little bit of exposure to certain core things. Bitcoin, Ethereum, gold, dollar cash that everyone seems to hate, even though when you walk into a supermarket, you got to pay for your shit with dollar cash. Dollar liabilities in a bank account because, ACH and wire transfers and FedNow transfers come in handy. Chase bill pay and quick pay where you send monies, split the bill and do all that stuff with your friends when you go out. It's pretty meaningful that you can engage in that kind of activity. So we have exposure to those kinds of positions. Hope that helps. Where were we? Interesting stuff. So that was Dan's question about GMX on Arbitrum, and we headed down that road. So just remember position size, remember liquidity conditions, remember diversify, and remember that this market is screwed. You don't expect anything to be significantly appreciative until you start to see this go up. And this is just 10%? No, less than 10%, but still 22 trillion down to 20.81. That is a massive reduction in available currency units in the system. And this thing looks bad. This thing looks really, really bad. And what happens is, as much as there's no coupling whatsoever between crypto markets and traditional equity markets, other than the commonality of liquidity, they're loosely coupled vis-a-vis sentiment and fear. So this is not necessarily a pretty technical chart in any regard. As a second rejection of the 100 SMA after all the significant depreciation, considering macroeconomic conditions, supply chain catastrophe with regard to food and the Ukraine situation, reduction in global currency supply that basically has been financed by Japan and China. What is that? LSA money supply. So Japan has completely invalidated, cured all of the depreciation of U.S. or contraction of USM2. And then if you consider China, it totally breaks it out to another level. Good morning. For an asset like Curve or Convex, where do you find a buying opportunity? Cheaper. There is going to be no number that I could state. What I can state is everyone has to find their own number and do your calculation. If you have X amount of dollars and you know that you want to acquire X amount of a particular asset because X amount of a particular asset would produce calculated cash flow into the future, then that's your number. Can you acquire that many of the token, of the asset? What price will you be required to get that asset at to achieve the portfolio composition that will do what you're looking to do? And if you cannot acquire that number, you adjust your expectations for the future, or you invalidate even considering taking the position. So, frankly, Convex has been on my mind. Note that I do have the chart up. I would love a discount. I would love it to get back down to the bottom of the range. I don't think, $1.70 would be a nice deal, and that would be based on the curve narrative and it being a significant source of dollar liabilities over the next decade. And they have a lot of control over curve. And then you have the other liquid derivatives, but I'm not too interested in derivatives. I'm interested in third-party CapEx to finance vote rentals. And obviously, the Convex vote rental system is renowned, but has been significantly depreciated. So what kind of size would I need? I have enough capital to achieve the size I want. I would not even consider it at this price point and these market conditions. We see a big capitulation. Someone offloads a couple of mil, like the Luna Guard. And you see a nice wick down to $1.50, it's probably going to force me to take a position. And macro consider that might still have a significant risk profile. And that's unfortunate, but in life we take risk calculated risk. So if you see that kind of significant depreciation on something that you think has systemic significance going into the future, at $1.50, $1.75, I'm going to take a risk like that. I mean, you're talking about a 75% depreciation in price from where we are. Not even from all-time high. Jesus Christ, that's not even a consideration. But from where we are. So I would carve out something at a 75% less price than current. Albeit, I would hesitate and evaluate macro conditions, especially liquidity conditions. Because if M2 drops 25%, nobody should be buying anything, and you should be literally expecting your neighborhood convenience store to go out of business, as well as the local supermarket, as well as potentially even the local municipality and government. So there's plenty of reasons to completely invalidate even a risk-considerate behavior. Look, that would be very risk-considerate. I'm like, all right, if I see Convex at $1.75, the bottom of the purple range that you see right here, that seems risk considerate. I'm buying something at an extremely depreciated price that I think is undervalued relative to its potential usefulness. But macro conditions say something catastrophic is occurring. M2 contracts 20%. Something systemic is occurring. It invalidates me taking that position at that time, and I need to reconsider my behavior accordingly. It's an ongoing calculation, your behavior in these markets, every second of every day. Good looking out, Cap. You're very welcome. Lucian, I have no stables. I've been too impatient and prefer to compound rather than selling my reward for USD. That is considerable. So every week you're making revenue, income. Bear in mind, there's a tax associated with income, unless you've set up some sort of tax, compounding friendly tax structure like a Roth IRA, and you have these assets in a Roth, which has no tax obligation, or tax-free growth. The difference between a Roth and a regular IRA anyway. But trusts are infamous for offering tax-free growth. So compounding works. I can't speak this as to what the optimal choice is with regard to reporting requirements and accounting management, but compounding does work. Albeit, compounding is an investment. Adjust your frame of reference and your definition of behavior to you're not compounding. What you're doing is you're taking your income that you make, which is equivalent to your salary from work, except you own something that's paying you just like work would, and you're saying, I'm going to spend this money in a time when the captain's been speaking for the last half an hour about how shit the conditions look, and everything looks like it's going to significantly depreciate. So maybe now is not the opportune time to invest, and you take your weekly income and you accumulate it in what is appreciating, which is dollar liabilities are appreciating significantly compared to basically any volatile asset. So do consider that. Compounding is meaningful, but you are investing on a weekly basis. Now, bear in mind, it's expensive on mainnet. We've seen gas up at 200. It's been pretty expensive. Prefer to compound rather than selling my rewards for USD. I was waiting for the liquidity to return before starting to sell into USD. Oh, so your yield is not in dollars. You would have to liquidate, and that has a transaction fee associated with it. So there's some very complicated considerations and equations to deal with the nature of crypto markets. We have income that's not dollar denominated. It might as well be in euros or yuan. It's just a foreign currency. Curve is a foreign currency. FXS is a foreign currency. And USD is appreciating relative to those foreign currencies. So consider these equations, flip the script, and try and redefine your behavior into something that is more of an analogy, something that allows you to have a different perspective. And by doing so, you potentially realize different behaviors that you can choose to do that may be better, hopefully aren't worse. But in the end, you look back in hindsight, and that's the only way you can measure how well your choices did. You look, DJ short sleeve. Are you prepared to accept your capital decreasing? Listen, if you're, what I just argued is that you're making income on a weekly basis in a foreign currency, and you're choosing to keep it in that foreign currency. Are you willing to accept that capital in that foreign currency denomination to depreciate? So that's the equation. Or would you invest that foreign currency into the domestic U.S. currency, which is appreciating? So the dollar is an investment, especially when your income is in a foreign currency. See, flip the script, and it gives you a different perspective. You're compounding in the foreign currency, but maybe you invest your foreign currency income into another currency that's appreciating, what happens to be dollars. So be considerate, obviously, of transaction fees, and that obviously complexifies the equation. Up and down we go. I have a decent bag of GLP, but I don't see that as stable, but as an asset of its own with yield attached. Okay, these are reasonable arguments, very reasonable statements, and definitely complex considerations. Why not get into an asset which decreases less than re-enter? Well, just remember, re-entering and trading requires technical observations and work and attention. You're sitting in front of a stupid computer. And we come back to maybe the argument I made earlier where 2023, I'm going to take 2 positions for the entire year. Something simple, which is different than what everyone does. Everyone's like, when's the market going to bottom? When's it going to start going up? And you're going to drive yourselves nuts. Set a limit, set a reminder on whatever app you use to monitor price. And if you get a price target hit on Convex at $1.75 or Curve at 60 cents, 50 cents, you're like, oh, now let me look at macro conditions. How's the debt ceiling? How's Treasury issuance? How's USM2? What the hell's going on in Japan? What the hell's going on in Europe? How's the war doing? And then you're like, all right, things look decent. I'm going to take that position I wanted. Or things look so-so, so I'm a little uncertain about the future. All right, let me take 25% of that position I was thinking about taking at that extreme depreciated value. I mean, Curve of 50 cents, you're like, all right, I got 10 grand I want to invest by the end of 2023. I want to put 5 grand into Curve, 5 grand into CVX at $1.75, Curve at 50 cents. So I set my reminder for Curve at 50 cents, and macro conditions look like shit. I was going to put 5 grand in. Let me put 2, because macro conditions are horrible. Let me put 1. Oh my God, macro conditions look really horrible. I got to wait. Curve might go down, might go up, but it's irrelevant. What's pertinent is uncertainty. And unless you have confidence suggesting that the system is working and is going to start to go in the right direction in the short term, you wait to assess. More information, better decisions. Ethereum stopped finalizing blocks. I missed a couple. You're right, DJ Shortsleeve, on GMX. It's going to get, the chart looks horrible. And just look at the change of liquidity in Arbitrum. 3% less liquidity means literally 3% potential less financial activity. There's 3% less pie for people to acquire. And who accumulates most of the pie is the people with the pie, the whales, people that have $20 million on Arbitrum. And they're capitalizing because they can move the market to do as such. Any risk of lending my stables to a pool on Curve and getting a few percent yield while I wait for good buys in the market? Sure. What if it's a $30, $40, $50 transaction fee and you're getting 5% on $10,000, which is you know, $500, and for the year, and you can't remove it until 2024. And if you do remove it, you just have to do a transaction fee to get out, and it costs you $100 to do those two transactions, and you've made only $50, and you want to take your money out of the LP position. So, you know, LPing works for 5%, but not in this market. Not with risk-free rate of return of U.S. government securities being at 5%, money market funds being at 5%. That kind of rate of return on cash invalidates a significant part of everything that's occurring in the crypto markets. And that's just true. So, you know, bottom line is it's sometimes good to do absolutely nothing until you find something that's good to do. And you need to do calculations and think. And that's why I go back to what I just said about, all right, 2023, I'm going to take two positions the whole year. And that's probably very reasonable considering the amount of time it takes for policy adjustment to unfuck a pretty shitty directionality. You know, by the end of 2023, even if they adjusted policy, things might start to look better. So that means until then, things will continue to look worse. Ethereum stopped finalizing blocks today for 30 minutes. Seems that validator diversity was a problem and solution. I'm considering becoming a validator with a minority client to support the network. Yeah, I like the idea of being a validator as well. I just need to have a reliable way to do it. I would want to, I don't trust my local ISP, so it's complicated. And I wouldn't mind being a validator. Obviously, it's not that lucrative, but it can be in the future, and I don't want to speculate on what may be lucrative in the future. I want to focus on 2023. I want to find some cheap assets that I think are systemically significant. So, you know, frankly, I fall into that camp of for 2023, I probably want to take one, maybe two positions at some point, and I'm kind of hesitant to do anything, probably, depending on more information. I need more information about what they're going to do with the debt ceiling and how much debt they're going to issue and how M2 looks towards the end of the summer. It's months. It takes months for all this stuff to play out, and everyone's like, what am I going to do this week? What am I going to do at the end of the month? No, check back in 6 months. You need to extend the time horizon to really get a perspective on the system. There's plenty of reasons why the dollar could shoot back to 103, 104, 105 and get invalidated somewhere below the most recent blow off top of this 6 month chart. It's got to be one of the most interesting charts. Let's go out to the yearly for the fun of it. On the yearly, it's an even a more prominent blow off top. But look at this. Look at 2002. You went right up for a double top in 2002. Listen, you see that candle and it goes back to 114 in 2002, 2023. You're like, oh shit, there was a double top in 2002 as well. So I'll be like, all right, that makes sense. Now you really have confluence suggesting that'd be an incredible 2023. Look, that's for 2023. That requires 7 more months to get that candle body close. In 7 months, if you see the dollar race to 114, everything's going to be an absolute catastrophe. Everything is going to collapse in price. That would be an absolute devastating financial condition. But if you see 114 and then in start of 24, you see the dollar come down significantly, back to like 111. Hard to get confluence on a yearly candle. It's like what happens at end of 2024 into 2025. But let's say you go out to the monthly and you see that double top at 114, and then you see the breach of the TWAP to the downside again. So it'd be a nice double top on the monthly. That would be very interesting. And if that occurred at the end of 2023. So there's some significant confluence suggesting the dollar is being controlled, because the dollar is not an organic phenomena. It's a relative policy tool. So look, I'm giving you a time horizon towards the end of 2023. That's what I'm thinking about. Like, sure, if I see my assets that I want completely annihilated by a dollar rallying to 114, and then I see the dollar start to weaken and soften towards the end of 2023, I'm like, oh, there's the confluence I need for curve at 40 cents, 50 cents, convex at $1.50, $1.75. Be very careful in this market and look for significant confluence. The markets will take your money. Blackie, hey Noah, how often you talk about Raul and his view on the market? Always. Raul Powell. You often talk about Raul. Raul Powell is who I talk about. He's got one heck of a perspective on markets, especially from a liquidity perspective. And the correlation he's observed between M2 and central bank balance sheets, G7 perspective, is quite profound with that 97% correlation he talks about. And it makes sense. It's one of my most favored perspectives on markets, but there's plenty of reasons why time horizon could be quite painful with that perspective. Things could take 6 months, a year to find confluence of directionality. So while you could have an extreme manifestation of what he talks about in 2024, like, oh, what he's talking about is playing out. And frankly, what he's talking about is playing out right now, but the remainder of 2023 could be a financial catastrophe. So time horizon is very complicated to get your head around. Other people that I listen to, yeah, I like Luke. Luke Roman's got the good perspective on what's playing out actually in the relative short term. Big long term, the big perspective is definitely Raul, in my opinion. And Luke has a good grasp of what's the flow of capital and the debt servicing obligations and tax receipt risk, because it's all just collapsing and our debt to GDP ratio is catastrophic. So that's some good stuff. But obviously there's plenty of other quality brains out there. Lynn Alden's got a quality brain, and what Brent Johnson talks about is quite significant. Brent's topic is ultra long-term time horizon. That's like the destination. That's how this all ends. This all ends with every other fiat currency failing, and when they fail, the dollar goes to infinity and beyond, and you see the DXY at 400. What's the time horizon on that? How many cycles are remaining? What kind of forces are in play? Forces that are in play that affect that manifestation. That's the destination. You have no idea what time horizon that is. So that's why we talk about the DXY chart, and structurally and cyclically. And if you see a double top at 114, it's going to be nice confluence, especially if you see a breach of the TWAP to the downside for further continuation to the downside. And I absolutely love this 6 months chart perspective, especially with this massive shooting star to the upside at the end of 22. My expectation over the next 3 years, along with Stan Druckenmiller, is a cyclical depreciation of the dollar. Now, what happens in 3 years' time is probably us approaching the 6 month TWAP at about 97. And there we see a breach to the downside. We could see a lower low. Structurally on this chart, we've had lower lows. But look at the time frame. The lower low is 92. 1992, and we didn't get to a lower low until 2008. Oy, oy, oy. So time frames are very hard, and they're very long. Igor, hello Noah, why Rook is 600 to up in 1 month? No idea. It's off my radar. Soon, good morning, a pleasure, Gelds. FM in the house, PulseChain launching real soon. Yeah, just remember that this game is scored in dollars, and every stablecoin on PulseChain is worth 0 because you cannot put it on a debit card. And if you sell it on a bridge? Is there going to be any bridges? There's going to be an exodus of that capital because every stablecoin is worth zero. So everyone's going to sell the stablecoin worth zero for something that's worth something. So there's going to be a very interesting market dynamic that plays out on anything that forks Ethereum. Because the assets inherently have zero value until they're able to be valued against a base currency. And without capital flow capacity, without bridges, inherently it's a zero-sum game, of zero value. So it gets quite complicated. The most important thing to understand crypto markets is foreign markets, is economic systems, and the relative value of currencies. And the value of a currency ultimately comes down to, can you bring it into a store and buy something? Can you put it on a debit card and buy something? And if you can't put it on a debit card and go into a supermarket and pay your bill at checkout, you got to sell whatever currency you have for another currency that you can go into a store and buy food with. So that is everything. That's how you assess the significance of a system, the significance of a currency, the significance of an asset, its purchasing power in an actual real store. So be very careful what goes on with any fork of Ethereum, not just PulseChain in particular. I'm interested in its launch as well. Let's see what kind of bridges are available. I don't really give a shit about transaction fees, but that's my size. And frankly, anyone that has a decent sized portfolio doesn't really give a shit about transaction fees. But if you do give a shit about transaction fees, I mean, Optimism is basically free. Arbitrum is dirt cheap. Doesn't cost anything to operate on Optimism. And Optimism has a lot of software, a lot of protocols, it has everything. And Arbitrum obviously has a tremendous amount of DEX infrastructure, and it's dirt cheap to operate on Arbitrum. So then you got BSC, which is basically cheap as well. So I don't see any rational way to say cheap transaction fees means anything in this market. That's an old narrative that's long gone. Um, dare you go on to like the Polkadot EVMs, Akala? You go on to the Cosmos Hub. This is Cosmos Hub, various Cosmos Hubs. The transaction fees are basically zero in many cases. And if not zero, they're basically negligible. So anything new that's trying to work based on cheap transaction fee narrative has basically an invalidated narrative that's just not significant technologically at all. Food for thought. So I'm looking forward to it launching because of just the sheer size of the community, but frankly, the narrative is invalid. What percent of a pool does LPing start to make sense? Yeah, you probably want a large percent of the pool. Now, if you want to have high confidence in productivity, you want to dominate. So to dominate, you potentially need a large amount of capital, 20, 30, 40, 50% of an entire LP. And now the problem is LPing is not often productive. More times than less, you'll lose money LPing. And unless you have, $500,000 to $5 million LPs on mainnet, you don't really have much leverage because of the gas fees, transaction fees. You're constantly needing to adjust your ranges on Uniswap. You can have much more fun on Arbitrum, play around on like a Trader Joe. And so, I'm not a fan of LPing, and I've done it so many damn times, and maybe I've broken even and made a little bit here and there, but the vast majority of the time it does not achieve what I'm looking for. It's like the only reason you LP is if you have a business structure that requires you to engage with markets where you don't necessarily have exposure to asset directionality. You're literally just You have an investment to make. You have $1 million to invest, and the LP is expected to generate 10% for the next year. And you're working on that kind of ROI expectation, and that's part of your business plan and your prospectus for the next year, a 10% rate of return. So LPing is just difficult in that regard. I hope that helps. Let's shut it down for the day. Be careful in this market. I expect people to try and take your money left and right. So just be different. Rewind this video. We'll have this video again on Monday, and we'll try and flip the script, change the narrative, be contrarian, and talk about markets that really matter. It's just so wrong when people say crypto markets don't matter. They just don't understand the story the way I tell it. 32 people remaining on the stream. I appreciate you guys sticking around to the end. 12 likes. Click that thumbs up button. Thank you all for joining. Tell everyone to subscribe. After party on Discord for the most rational community in the entire crypto space. I wish you all a wonderful day and weekend. Peace.